Okay, in next hour or so, maybe less, we will talk about another side of the strategic decision under risk conditions. And there are lots of books have been written about decision making, but this one is about making decisions under risk conditions. That said, that means to say we are excluding the studies of decisions under certainty and under uncertainties. Both are the extremes of the spectrum, and for the definition purposes, we can narrowly define that certainty means you don't have risk. The probability equals either 0 or 100. And for the uncertainty part, it is a lack of information. You don't have enough information to make right decisions. So that's another set of techniques. So both certainty and uncertainty situations will be excluded. Okay, that's just kind of condition of today's discussion. I will carry on and start right away. This is my bio, and mainly I am in construction, large projects, scenario, and the environment. So in the next while, all the examples I'm going to use will be about large construction projects, more or less in oil, gas industry. In recent years, especially last year, there are quite a few large projects in Canada. Let's say use Canada as an example. Happening, the major events happened last year in Canada. We're talking about the mega projects like 33 billion, Petro-Canada's decision, Dutch Shell's decision, 27 billion. That's a two large oil sands projects announcement. And in the meantime, also we have acquisitions like Rio Tinto versus BHP Billiton. That's another one. And BCE, another buyout, the big one. So there are lots of big projects that make headlines in the newspaper and the media. Now, if we look at those major investments and the major projects announcement, how do they derive that conclusion? Say, hey, we need to go ahead start this major or mega projects. So that is strategic decisions made by board of directors or CEOs. Now, based on what they make that kind of huge decisions? If you look at this screen, you'll see there are two things that drive the decision making. One is growth, continuous growth to meet shareholders' value and the shareholders' expectation. And the other side is because of the competitiveness in today's market, and companies need to survive. How can they survive? One of the strategies is to grow. So if you look at it, and business survival and further growth, these two factors are the driving forces for the strategic decisions. Talking about the decisions, if you don't have options, you don't have any decisions to make. And because you have options, you have alternatives, therefore you have to make decisions. Decisions, if it's under certainty, you have solid information, that's easier. However, in most cases, decisions are made under risk or uncertainty. And as we said, under uncertainty situation, that's a lack of information. You need to go out and seek the value of the information aspect and to push from uncertainty stage to risk stage. So that's not our discussion. Under risk stage, that's what we're going to talk about. Okay. When you have options and you have to make decisions, and the decisions must be supported by your long-term goals, missions, and visions, where your company wants to go. And based on those, you make commitment once a decision is made. So that is a very simple diagram to show the initial stage of business concept to the final commitment. There is a survey out there, and the survey was done in 2006 by McKinsey Corporation. They surveyed about 500 large companies. When I say large, it's revenue over above 500 million. So they surveyed about 700 people, and this is the result. And amazingly, 77% of survey respondents said the rigorous decision-making process is not used. And although they also admitted that the processes are in place in organizations. There are processes, not lack of processes or techniques. There are processes and techniques, however, people don't use it. And talking about the decision-making, and also 63% people saying to do decision-making really is to assess risks and reward, the benefit side. So really, if you look at decisions and you look at each option, what you do is to analyze the risk side, means negative side, and also the benefit reward side, the positive side. Although in theory, risk has both positive and a negative side. But here, what we're saying is they are assessing both risks, negative risks, and positive benefits. Let's look at a scenario here. One thing must be clear in decision participants or decision makers' mind. To do major decisions, there should not be a tactical micro environment. Must be strategic macro environment situation. And either you do acquisition, or you do expansion, or you create new projects that must be governed by growth strategy and the company's vision and mission. So it must be made in the consideration of macro environment in the business where it stands. And for example, let's use major new projects as example. You need to analyze both qualitative aspect of the projects or options, and also to quantify the impacts. Let's use NPV as the example. So you need to quantify the NPVs to see qualitative assumptions are good enough or not. And lots of situations in today's market are that companies tend to use only quantitative NPV to derive the final conclusions. And well, I'm not saying it's good or bad. I'm saying it's not enough. We can improve. That's today's topic. How can we integrate both qualitative and quantitative, use stochastic model to derive the appropriate decisions? And lots of scholars and academic professionals have defined decisions under different situations. Peter Drucker, as early as 1954, has written a book about decision making. And remember, at that time, you're really talking about 1950s, and risk was not a welcome topic. And if you read the book written by Peter Morrison, he has written a book called The Management of Projects. In his book, he said, since 1960s, really the management techniques have not been developed significantly except the risk management. So from his conclusion, and you can see before let's say even 1980s, most decision making were following problem solving techniques under certainty situation. That's how Peter Drucker's book at that time, early 1950s and 1960s, were quite popular. In 1980s, Alan Baker, he wrote a book, and he talked about uncertainties. And Under uncertain situation, as we said earlier, by definition, your lack of information. So you cannot use the stochastic method to derive the final good decisions under uncertain situations. Even Simon French, in his book, he also concluded that uncertainty is not good decision-making technique. So you cannot make wise decisions under uncertainty situation. And there are some other techniques, that's regret theory, to derive decisions. If you have to make decisions under uncertain situation at the early stage of project, you may regret, but that's one technique. And risk, as we understand now, and also becomes one of the very popular management techniques, and it is a very welcoming trend that decisions under risk situation using appropriate tools such as Monte Carlo at risk simulation and probabilistic decision making using precision trees, that kind of a thing, and even newer optimizer and some other technique and tools. So you can see this is maturity stages from early 1950s all the way to today's situation. From oil gas refinery refining project perspective, first stage you need to have a business case. That's always, no matter what you do, either new projects, expansion, or the acquisition. You have to have the business case. And following that, when the decision is made, you move forward to the project execution phase. That's where the capital spending starts. And when the project is finished, the facility will start generating the revenues. And that's your operation phase. From operation phase, you move into marketing, refining, and from there, you have your steady and stable circle to run: production, refining, marketing. Unless, as we said earlier, you want to grow, the next phase will be, let's go back, expand, or new projects. Again, you open the gate, go back to business case study again. The whole cycle goes on and on. So this is a lot of growth businesses, they follow the model like this. Okay, let's talk about business case phase. At the early business case stage, you don't have lots of information. However, many large decisions are made at this stage, business case stage, to say, yeah, we have to go on, or we stop and we cancel the project whatsoever. So decisions are made at this stage, which will have a huge influences and impacts on the later on the execution phase. What we're doing here at business case study is to determine the future opportunities and to assess the risks for future reward, and also to determine the decisions at this stage will meet significant strategic needs of the company growth. So that's what we're doing at this stage. And obviously, at this stage, there's a paradox. And one way to make smart decisions is to collect a lot of data and reliable information to help you make right decisions. On the other side, because it is at early stage and is very expensive and sometimes unrealistic to collect reliable information. So you have to make decisions based on limited data and information to make decisions. Okay. So here, decision makers are pressured to make a quick decision, and in the meantime, they don't have enough materials and information to make quick decisions. So it really is a paradox here. The technique I'm going to talk about here is the integrated processes encompassing both qualitative and quantitative methodology. So the qualitative side, more or less, we're using risk matrix to measure the risks, severity, and positive benefits and reward significance. And based on the force field analysis, which is really to measure which option has bigger risks or bigger rewards. By comparison, qualitatively, you can derive a set of decisions. Is that decision good enough? You have to use numbers to derive another set of decisions to validate your qualitative decisions. So that's where the NPV simulation comes in, and for the comparison purposes. That's what I call it integrated stochastic method. So let's look at the qualitative side in terms of risk. And as we said, under macro environment, we're looking at the big pictures. The big pictures using Pareto's law, really you're looking at that 20% big rocks which have bigger influences of, which have the 80% influences on the results. So based on that 80-20 rules, if you look at the big picture and on the major decision-making processes, most of the risks are around political stability, economical returns, and your social responsibility, and the technological risks and reliability. So really, when you look at it from project perspective, I'm looking at the four aspects of risk and the rewards. Next thing is very, very important to have a risk matrix. Risk matrix, in simple layman's words, are basically to measure the risk severity by how likely that risk or hazard is going to happen or occur. And if it occurs, what are the consequences in terms of severity or consequences? And for the consequences, you can also put the measurement by numerical numbers. Let's say critical means the loss of revenue would be, say, $50 million. And if it's negligible, say less than $100,000, I won't consider it as a big risk. So depends on the company's risk tolerability and the risk's attitude. You can map out the consequence and the probability scales to measure the risk and the reward severity and the significance. When we talk about or design the risk matrix, a few things need to keep in mind. One is the risk categories. There are, let's say, internal risks and external risks. There are risks internally and controllable, which you have certain degree of manageability. And for those, some external uncontrollable risks, such as market fluctuation, and you have no controls. You have to use some other techniques to deal with those. And some of risks will be specific to the project, to your company, and some of them will be systemic and across the board. And can be enterprises risk and can be project-specific risks. Can be qualitative, can be quantitative. So you have to, the first thing is to decide what kind of risks, categorize them, and understand them. And we always use work breakdown structure, WBS, which is a common acronym. Lots of people in organizations have them and understand them. But risk breakdown structure is a less known, less popular acronym being used in organizations. Even in some literatures have talked about risk breakdown structure, but not in great depth. So here, you do need certain degree of risk breakdown structure to group your risks. And remember, you don't have to go to too many tiers. Otherwise, you lose ability to manage it. This is a kind of template for qualitative risk assessment for each and every options. And this is a technique we use, PEST. That's really PEST is a political, economical, social, and technological aspects of it. And from this chart, you can see for each option, you assess the risks and benefits. And using the risk matrix, you measure the scoring of each risk items and each benefit items to see at the end of the day, by numerical comparison, your risk is exceeding the benefit side or vice versa. So here give you indication which option has a better risk or reward, and this will help you formulate qualitatively, or some people like to use subjectively, a kind of initial path of decisions. If you look at the lower part of this, you will see, yeah, option 3 has a better reward than option 4, which option 4 obviously is very risky in terms of qualitative risk assessment. So using risk identification processes, risk ranking techniques, helped by the risk matrix, you can have the first pass of the decision made at this stage. As we said, qualitative decisions is a little bit more subjective, and we need to do a little bit more work. And ironically, lots of people have the perception saying, if we have numbers, if we have the quantitative conclusions, they are objective and they are more convincing. That's not true. And there are literatures and studies showing that models do not conclude better decisions than qualitative final conclusions. So don't get that perception saying, hey, that's the right perception. They're not. Okay. And let's talk about quantitative decision making. And you can use IR, NPV, but the most popular decision making tools are using NPV as a model tool, because common understanding of NPV. Again, uncertainty pops up again, and as we said, you can use the payoff table, you can use the regret theory, whatsoever. So decisions under uncertainty, let's exclude them, and let's concentrate on decisions under risk conditions. We try to use calculations. However, under risk conditions, you will have a hard time to use calculations. Instead, you are pushed to use simulations. And simulations is fuzzy logic driven. And calculations, you use concrete and absolute numbers to have the final A number as your final conclusion. But simulations will give you a range of numbers associated with probabilities. So you won't have a number. for your final conclusion. And if you look at the economic NPV model, and you have WTI pricing, you have the volumes, you have capex, you have all kinds of variables, and maybe one of them is WTI pricing. And if you look at the history from 1947 till 2007, and interestingly, and from 1947 till 1973, the oil price maintained at $3 per barrel, without a huge change. But in 1963 and even 1980s, 1991, 92, and even today, you can see the oil prices fluctuated beyond the norm, beyond the people's expectation. So what number do you use for your economic model? So that becomes a huge decision here yourself. Do you use $60, you use $80, or today's price you use $100 for your economic NPV model? So instead of using one number or using assumptions, different scenarios, can we use a range of WTI pricing in your model? Use at risk, use different distribution to give you a range of outcomes associated with the probabilities of occurrence, which really reflects in companies' risk tolerability and the risk attitude. And some companies tend to risk avert, some companies tend to risk neutral, and some companies really aggressive. So the simulation risk probability-based conclusions are better tools suiting projects risk. The company's risk attitude. Life cycle value assessment is another tool to use, but for some reason, LCVA tends to be more quantitative than tend to be more qualitative than quantitative, and so again, that's another misleading information. And some early projects they say, hey, let's do LCVA, but LCVA they should have both qualitative and quantitative components. For whatever reason, a lot of LCVA are done only on the qualitative side, ignoring or play down the quantitative side. If we look at the risk model for the NPV, here you do need to have some key variables as inputs to the risk model. One thing is the risk registry, which is always missed as input to the risk simulation model. And probability distribution, yes, because of the tool itself. For example, at risk has designed many ways of describing the risk probability distribution, so you can't miss that. But risk registry get always missed. Risk correlation, both negative and positive correlations, because again the tools, the at-risk tool, simulation tool, have the functionality that help you and allow you to do proper correlation. So you barely miss that two parts. However, risk registry get always missed. And into this black box, always to majority of the public, risk Monte Carlo still mystery and still a black box. And the output will give you NPV value associated with the probabilities, as well as the sensitivity tornado chart to give you what are the key risk drivers based on the standard deviation and regression correlation. And that will help you in certain degree to identify what are the key drivers which have wider variability, and also give you different values, NPV values based on risk attitude. And you can design and build your risk model in different ways. And this is just one way I just throw them in as for the experiment purposes. And by no means this is only way. There are many ways. Different people using different ways to build a model. Okay, you can measure NPV, you can measure the return, and you can use different distribution. For simplistic purposes, I just throw in the distribution, use the trigene, and for the WTI, use the log normal. You know, different ways of distribution. There are 120 of those. So it's up to you and your skill set to choose and pick and which distribution you want to use. Okay. I did a survey last year in 3 countries. I took the opportunity at the Palisade at the Risk Conference last year in Miami, and I did a survey to about 25 people in the room to test the understanding of the risk and to test the correlation between decision quality and using risk approach. And also, I surveyed another group of people here in Canada, in Calgary, at another risk seminar, and about 50 people here. And during that session, we had a majority of attendees from projects in oil gas industry. And in Miami one is a very diversified attendees from insurance and finance, economics, and projects, so all over. But in Canada one, more or less focused on oil gas large projects. And also in December, I was in Abu Dhabi, UAE, in Middle East, surveyed another group of people, about 30 of them. I got 21 respondents. And again, in the UAE one, the attendees are more or less in oil, gas, large projects. So based on the survey information, and you can see about 79% of people believe if we use risk approach, that means qualitative and quantitative Monte Carlo, the decision quality can be improved by between 100% and 50%. And the people believe, after I did all 3 presentations to those group of people, they told me by survey information that quality of decisions can be improved if the risk approach is taken. Okay. And there are a couple of scholars also, quite a few scholars talk about it and support it. I picked the 2. One is Finkel in 1990. He said, decision made without taking risks into account is barely worth calling a decision. And I'm not sure he's discounting Peter Drucker's early 1950s problem-solving techniques, or he's promoting risk techniques. But in early 1990, there was a talk to relate risks to decisions. In actually last year in Colorado School of Mines, and Dr. Walls, he has traveled in North America promoting his risk teachings, and in his risk teachings, and he applied risks, especially strategic risks and decisions in options and stock options and buy call, that kind of stuff, and quite interesting. And I attended his training session. It's quite interesting. And again, he concluded that strategic decisions can have significant impacts on the viability of the firm if decisions are not made using appropriate tools and models, and having good having good understanding of risk attitude. So this is one survey conclusion. Again, talking about integration and using stochastic models, this is it looks like entangled lines, but this is a true methodology and processes. I do have a model built in a spreadsheet from a qualitative risk identification, risk registry, risk ranking, force field, and decision tree, Monte Carlo, the whole thing about the 10 steps together. So this slide really reflects the model itself from A to Z, from risk identification associated with each option to the final conclusion recommending the highest value decision options. So this is a kind of a diagram to show that model. So either it is a growth project or sustaining projects, expansion projects. If you have different options, can be used either for major projects or can be used as small as, let's say, for example, do I want to replace a vessel in an operating refinery? And you have different options, let's say, replacing the entire vessel, overhaul the vessel during the shutdown work, or say addition, system modification, or whatever. So if you can have different options using the same processes and the methodology to derive the better decisions. So the key message is you need to use both qualitative and quantitative methodology. And one way only, one method only may give you biased decisions. So with the help of decision tree, with the help of the risk Monte Carlo simulation, and as inputs to the force field will give you optimized decisions. So that's kind of a diagram to show that. And this decision tree using precision tree software is not a normal decision tree. Normally, when you use the precision tree, you are asked to type in the probability of occurrence of that event, and you are asked to type in a value. And here, all the probabilities of happening and the values are the inputs from a simulation, risk simulation, and the force field table. So those probabilities are calculated probabilities based on risk registry, and the dollar values are the results of the Monte Carlo simulation. So they're all linked together. And that effectively removes some degree of subjectivity in using decision tree in a normal way. And this is the final table you should present to the higher or senior decision makers. So the top one, net sum value, will give you qualitative decisions. Say, hey, based on the qualitative PEST analysis and the force field analysis, we are recommending option 3. However, if you look at quantitative NPV value and IR, you will find some contradicting results. And you may question yourself, what's going on here? My qualitative and my quantitative, they are off the whack. Well, actually, this is the effective validation processes. Again, this will force you to go back to evaluate the assumptions you have used for your qualitative and quantitative assessment. This disparity truly is a validation process, rather saying, hey, if I use qualitative only, I would recommend option 3. However, if I use my NPV, I may recommend option 1. Interestingly, I want to bring up another topic here. If you read the risks and investment books, in the investment books, they always say higher risk, better reward. Taking bigger risks, you may get the reward, especially talking about the equity and the stock market situation. But here, not necessarily taking higher risks, you may get necessarily higher returns. There are lots of other factors come into play. And I have my doubts on a theory that higher risk, higher return. That applies only to certain situations, in certain degree scenarios, not applicable as a common theory. Here you can see using different assumptions, and you may have different results. Okay. And also proves to you that one method is not sufficient. Again, this is another survey to test decision makers and decision participants' risk understanding. And it proves that more you understand the risks and the risk principles, and the better decisions you can make. So survey of 90 project professionals in 3 countries, the same 3 countries we talk about, has confirmed hypothesis that higher risk, higher decision makers risk knowledge, higher decision quality. So what I want to test is the correlation. So if you look at the coefficient, the correlation coefficient is almost 0.7. Is a very good correlation. That means if you understand the risks better and have in-depth knowledge, you should make a wise and smarter decisions. Well, is that true? Well, this is based on 90 people's conclusion. Is the population big enough? Well, maybe not. However, that gives you some indication. You see the correlation there. Finally, again, 95% of 80 people confirm that if we use integrated approach, and you will have or yield better decisions. Okay. And strategic decisions under macro environment give you some of the conditions. That means number one is strategic decisions involve risks and uncertainties. That's given. That really is a fact. You know that. Any single method may not be sufficient. And I'm promoting integrated stochastic decision-making approach. And unfortunately, large number of companies do not use integrated stochastic method. And regardless, either is the popularity or is the understanding. And based on what I know, what I heard, is still not popular yet. And in the interview with some people, I was told executives got confused by the complex and sophisticated model results. So they would like to have a simpler way to derive the decisions. So that's something we need education. Still a long way to go to get that stage. So with that concludes my final presentation, and I'll open the floor for questions. Andrew, back to you.
Thanks, John. That was an excellent presentation. So what we'll do now is wait just a few minutes while people have a chance to compose some questions. If you have a question, please use the chat function in the floating toolbar that you should see at the bottom right-hand side of your screen. John, I'm also going to try and upload your presentation for people to take if they want, while we're waiting for them to compose some questions. Okay, John, we have a question. Can you see it, or should I read it to you?
I don't see it here.
Okay, I'll read it to you. This is from Adrienne Williams. She says, many thanks for the presentation. And the question is, what are some strategies you recommend to educate managers and executives inside firms where an integrated stochastic approach has not previously been employed?
Good one. That's a really good one. First of all, you should have a risk culture in the organization. And unfortunately, not a whole lot of companies have that culture. So instead of injecting the stochastic model and the methodology or processes to them, which will very likely confuse them, so I would start from a simple risk culture approach. That means let's introduce risk management concept, introduce risk registry, and give them culture that when they make decisions, when they have options, let's at least talk about risks of each option, talk about the upside and downside of each option. And lots of companies stop right there. Yes, they say, we identify the risks. What's the next step now? Can you quantify the risks and quantify the reward? So use the risk matrix to quantify the severity of the risks. And if necessary, go further step, use simple NPV model to further quantify the risk-weighted returns. So that's what I would recommend.